It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. Sitting here in the podcast today, the man himself, the mayor, the governor of the great state of Texas, the smartest guy in the room, Mr. Michael Becker.
Hey, Paul.
Michael, how are you?
Things are going pretty good. What's going on in the Old Capital world?
Oh, we're loving life, Business is great. People are wonderful type of stuff. And we keep doing, a lot of lending. So if you're thinking about doing a loan, we hardly ever say it. Come talk with Old Capital, your friends over at Old Capital, and see if we can give you some advice on how to structure these deals. Don't forget on October 24th, 25th, find a way to come to Texas to see and meet and negotiate a bunch of friends and family for the 2019 Old Capital Multifamily Conference at the House of Blues.
Third annual, right?
Yeah, third annual. As you remember, Rob O'Neill was about 2-3 years ago. Then we had the great cowboy.
Roger Staubach,
Roger Staubach. And then I can't tell you who's going to be here for this year, Mike. Unfortunately, you're sworn to secrecy.
That's right.
It's going to be at the end of July. We'll kick off who that person is. But I think you'll like that.
Somebody I was very aware of and looked up to when I was a kid. So still popular today. So it's
very popular.
Exciting to get a chance to meet him.
You'll have a chance to shake his hand or her hand or whoever it is. But going to be a great speaker. So find a way to come to Dallas if you can on American Airlines or Southwest or Delta Jet coming to see us any place throughout the country. This is the premier multifamily event. We'll have 750 or so investors throughout the state and also the nation come see us in Dallas. So we're looking forward to seeing you come to Texas. Again, go to oldcapitalpodcast.com, oldcapitalpodcast.com. And again, don't forget to leave us, if you think we bring value, a 5-star report on iTunes. A 5-star rating would help us. It gets us going, and we appreciate that. So, Michael, what is going on these days with interest rates, huh?
Yeah,
this is crazy.
It's crazy, right? So I remember we're towards the end of 2018, and as we record this right now, we're halfway through the year, 2019. But then in 2018, we are locking a couple deals around 5% and happy to get it because the rates are rising, and we thought it was this was the end, and then sure enough, it immediately turned around, and now you can lock rates in the high threes for similar product, which is crazy.
In fact, we just locked a loan last week at 3.89%.
Yeah, that's nutty.
Fixed for 12 years. Had the green program on it, so that's how we were able to get the low rate. But it's absolutely unbelievable, huh?
Yeah, so it's a tough decision right now. So the Fed just met as we record this a few days ago, and they announced that they didn't cut rates, but they're setting the stage to cut, rates going forward. So looking out there, the 10-year Treasury is just a little bit over 2% as we record this podcast right now. And, it was over 3. What did it get to? About 3.25%, I think, at the end of, towards the end of 2018. So, we've come down over 100 basis points in, 6 months or less. So it's been pretty dramatic decline. So, it's just a challenging environment. So really kind of your question is you go in, lock in a high 3 rate, or do you you can also get some pretty attractive adjustable rate mortgages as well. In particular, Fannie Mae isn't quite as aggressive right now on the adjustable rate mortgage, but Freddie Mac is. So if you have a little larger loan or a little bit more experienced sponsor and not in the small balance program, but just kind of the regular loan. I mean, we got a loan, about 45 days ago, we got a spread. We're 156 over 30-day LIBOR. So, we're what is that today? We're about 2.4 on the 30-day LIBOR. So, we're 390 floating, which we could probably fix that same loan at about 380 rate today. I would have to take a guess with us.
So why would you do that? Why would you take an adjustable rate
at a higher rate than what you could fix a 10 or 12-year loan at, right?
Are you guys crazy?
Are you crazy? But then you're going to look at
crazy like a fox.
You're going to look at the LIBOR is going to, they're projecting at least a 50 bip cut in 2019 is kind of what the market is indicating, and these floating rate loans don't have any floor. So, we can here very shortly have a 2 in front of our pay rate. And if it goes to, 25 basis points like LIBOR sat at for 5 years, 6 years until they started raising about 2-3 years ago, you can have a pay rate with a 1 in front of it with those kind of spreads. So the spreads really haven't gapped up yet. But now with that said, we're looking at a potential refi on something else. And a very similar size loan, and we're going to get a 178 spread. So the spreads have gapped up about 20 bips. It seems like Freddie is realizing that Fannie's out of the floating rate business. So they're widening their spreads a little bit to because they just don't have quite the competition. And everything I'm quoting you now has to be green or affordable, or you're going to get 50, 60 bips wider on your spreads, both for fixed and on the floating right now, because that's certainly been a problem with the agencies. They came out of the first 3 to 4 months of the year and just were going gangbusters, not worrying about their cap. And then they realized they were, each have about $35 billion cap, if I remember right, Paul.
Correct.
I mean, they were kind of outpacing where they're going to be full by the fall and not have any money towards the end of the year. So they started widening the spreads and forcing everyone to go into the green program, which is uncapped.
It's just like stomping on the brake pedal. So trying to slow things down, you raise spreads a little bit.
Yeah, so if you can't fit in green, then this doesn't really make as much sense today. So everything's got to go green or have an affordable component where they can get in their uncapped business, or it's going to be 40, 50 bips at least higher in your spreads. But right now it seems like the rates are down. Both with the 10-year Treasury, LIBOR's down a little bit. It's anticipated to go down further, but we haven't seen the spreads widen. Usually when that happens, it's because you're in a recession, and as the benchmark rate drops, the spread widens, so you don't really truly practically see as much of a benefit. But right now it's really unbelievable. There's both floating and fixed are in the threes, and it's really, I think, kind of continuing to drive the cap rate compression and pricing, and all these B class deals are now trading in the $120,000 door range, and a couple of years ago it was in the 90s, and so it seems like the last 2 years your average B class deal in Dallas Fort Worth is up $20,000 to $30,000 a unit. I don't know what you're seeing, Paul, but that's kind of what's out there right now.
Let's go back and do a little bit of a deeper dive. We talked about the benefits of the interest rates going down. What's the bad side of the interest rates going down?
I mean, I guess it's a projection that we might have an economic contraction, a recession. It's kind of what they're thinking. But until that happens, I haven't seen it yet. It's really driving and fueling the prices of the properties right now. So then the inverse about that, too, is if you were like us and you thought you were smart about 3 years ago and took out a bunch of 10 and 12-year fixed rate money in the high fours, you're going to sell your property now. Your yield maintenance or your defeasance, prepayment penalties have skyrocketed because it's a lever of, as the interest rates get cut, and it just makes your yield maintenance prepayment penalty go up. So it's causing a challenging environment for anyone trying to sell something with a yield maintenance prepayment penalty.
Work through that with me a little bit. If a lot of people are not familiar with what yield maintenance is, and we won't go into the equation on it, but a lot of people just kind of know about what a standard step-down prepayment penalty is. So if you have a $1 million loan and that it has a step down prepayment penalty of like 5, 4, 3, 2, 1, it's 5% on the $1 million, 4% the next year, 3%. It's stepping down, so you have a definition exactly what the cost is to say goodbye. Again, these are not like home loans that have no prepayment penalty. Most commercial loans have some sort of prepayment penalty, and especially loans that are secured through securitization, which means that like Fannie or Freddie have taken your loan and broken up into pieces, and in your 401k fixed rate people are buying some of it, and the pension funds are buying some of it. Anybody that's looking for a fixed rate piece is buying part of your bond securitization. So when interest rates go down, Michael, talk a little bit about what type of an impact that can have, whether it's on $1 million loan or a $10 million loan.
Yeah, so the way the yield maintenance of defeasance works is really, it's got two levers to it. It's really just kind of how much time is left to maturity. So the longer time to maturity, the higher the prepayment penalty is going to be. The closer you get to maturity, the lower it's going to be, and that's kind of that lever there. Then the other lever is what is your rate relative to the current market interest rate. So if you lock a rate when the 10-year Treasury is at 3, and then when you're looking to go prepay it, and the 10-year Treasury is 2, that's going to make your prepayment penalty go up quite a bit. And the inverse is true if it went from 3 to 4 and make your prepayment penalty smaller. So as the Treasury rates roll, it kind of has that kind of inverse relation to your amount of your prepay. So the lower it is, the higher your prepayment penalty is gonna be. So it could just be material, especially when you're in the $20-30 million kind of loan range. I mean, we're having a deal that's a struggle right now, and we got into escrow on something. We buffered ourselves about $300,000 to where we wanted to be, and the prepayments gapped up $800,000 in 35, 40 days. It's pretty unbelievable just to kind of watch it in slow motion here.
Because somebody is not assuming your loan, they're going to go out there and get a brand new loan. So when you pay off your loan, that yield maintenance, that prepayment penalty is going to be attached to your payoff. Is that right?
That's right.
So typically when you have, say, a 10-year fixed rate with Fannie Mae, for the first 9.6 years, 9.6 months to be exact, 9 years, 6 months, you're going to have a yield maintenance penalty. Then from the 9.6 months to 9.9 months, it's a 1% penalty. In the last 90 days, it's zero. So you can get out the last 90 days of a 10-year term without paying a prepayment penalty or a yield maintenance penalty. But before that, you're going to pay some type of a yield maintenance penalty. So you always have to think about what your execution at the end is going to be. If you're going to be in these properties for 3 to 5 years or so, maybe the 10 or the 12-year loan is not the right loan for you because it can be very expensive. Instead of paying, say, 5%, like a step-down prepayment penalty, it could be 10 or 15% because everything is done by that interest rate at the time that you go to pay that loan off. So talk with some of the guys at Old Capital and kind of give you some options of what's available out there on different types of prepayment structures.
That's, I think, where there's always some issues. There's also some opportunity as well where you can if you're out in the marketplace and you're looking to buy a deal and you have the ability to maybe raise a little bit more money or not worry about as much on the upfront yield, you can maybe take a little lower walk-in yield. Maybe you can target a few properties that have loan assumptions and get a basis break, a purchase price break, because the seller is having an ever-increasing prepayment costs that if they sold it free and clear, they would net less money due to that. So maybe you can.
Have you guys done that recently?
We've done that on quite a few deals here recently where we take, multiple $1 million lower purchase price, but then we have to assume, maybe above market economics on the loan, but we're just going to kind of use the loan assumption like a bridge and then, take that first 2 to 3 years, reposition the deal, hopefully have the prepayment penalty burn down a little bit as we get closer to maturity. And then ultimately we'll suck it up and pay off that prepayment penalty when it's a little bit lower after we've kind of driven, revenue and NOI up a little bit.
I've asked you this 100 times. What does SPI stand for?
Yeah, so strategic property investment. And what we do is really kind of our primary focus is just we go out and try to identify high quality investment opportunities and go out and raise capital through syndication and kind of put the deals together that way. So if people want to find out more information about us or potentially reach out to us, just the easiest way, simply go to our company's website, which is www.spiadvisory.com. That's SPI like spy, advisory.com. There's a contact us form, fill that out, and I'm always happy to set up a 10 to 15-minute telephone call with listeners off the podcast if you want to potentially talk about working with us.
But if you had, let's say, $5 or $6 million yourself and you were selling something up in Northern California or New York or Florida and you had an interest about trying to get into multifamily and wanted to work with you, what's the name of that?
Certainly. Just give us a shout. It's certainly worth having a telephone call. We do quite a bit of work with people that are out of state trying to come into Texas. And typically the typical story is I got 1031 money and I want to be in Texas and I don't know anybody or know how to break into the marketplace. So we've done some joint ventures with people like that or just simply help people identify and buy some properties as well. So feel free to reach out if that fits your situation. I'm always happy to have a telephone call with people that we meet off the podcast.
Again, your email address or your website address?
spiadvisory.com.
spiadvisory.com. All right, that was Michael Becker, smartest guy in the room. I'm Paul Peebles. Have a great day.